And good afternoon, financial professionals. My name is John Florence. I am Senior Vice President of Marketing here at E4 Insurance Services, welcoming you once again to The Brew, where we build relationships every Wednesday. Thanks for tuning in today. For those of you joining The Brew for the first time, welcome. Today, we're going to be joining back one of our favorite and best presenters, and certainly one of the most popular presenters that we have on The Brew, and that is Steve Walker. Steve is the Vice President for Institutional Accounts here at E4 and comes onto The Brew kind of regularly, sharing some of his really fantastic ideas or particularly around advanced planning types of topics. And today, Steve's going to be talking to us about using life insurance inside of an estate plan. So before we get to Steve, though, I would like to remind you that all of the brewcasts that we do are recorded, and they are made available to you on both the E4 website as well as on our YouTube channel, the E4 YouTube channel. So you can go back and take a look at those, look through the entire catalog of topics and guests that we've had on the show and be able to enjoy those there. It's also a reminder that any questions that you might have, please make those in the chat box and we can raise those to Steve's attention at that time. And also please remember that at the end of the broadcast, we will be doing a drawing for a free Starbucks and a continuing education gift card for financial advisors. So stay on for that, and Steve will pick the lucky number and you'll have an opportunity to take home something of a little bit of value to you. So Steve, welcome back to The Brew. It's great to see you again, and excited to hear what you're going to share with us today. So the topic is estate planning, and specifically how to add insurance into estate planning. And before we get into the meat of what you want to share, I just want to ask a really simple question. Who needs an estate plan? Is it everybody, or is it only the super rich people, or who should have an estate plan, Steve?
That is a great question, John, and something I get quite often. And it's great to be here. So really, everybody needs an estate plan because ultimately what an estate plan is. Oftentimes, when we talk about some advanced planning ideas, we start talking about different types of trusts, and we'll look at how insurance can enhance an estate plan and things along those lines. But really, an estate plan is what you want to have happen when you pass away. Where do you want your assets to transition to? So if you don't want to have a wild west when you're gone, granted, you won't be on earth to see it, but if you want to have control over what happens, everybody should have an estate plan.
Excellent. And when we're talking about that, I mean, I know in my mind, when you say estate plan, I think of some, just lots of different things that come to mind. But I guess what is a part of a estate plan? Is it just a will, or is it a trust, or is it a combination of those things? Is it more than that? Tell us a little bit about what estate plan entails.
Another great question. Really, an estate plan is, I kind of like to talk about it being a journey. It's evolving. Your estate plan is going to change over time, as your goals and concerns change. But really, some of those pieces that you mentioned, those are a piece of an estate plan. The most common, especially kind of getting started, a will, kind of dispose of your assets as you want them to. You've got healthcare directives. Later on in life, if you can't make your own healthcare decisions, you can tell your loved ones what you want to have happen in certain events. Power of attorney, financial power of attorney. Again, as we get older and can't make those decisions on our own, we can have those types of powers of attorney in place. And then when you get into some more affluent clients and clientele, then we start looking at different types of trusts: revocable, irrevocable, charitable trusts, lead trust, those types of things. So there's a lot of different ingredients that can go into an estate plan.
Okay. Well, it sounds like something that clients really need to begin that conversation perhaps with their financial advisor, but it may also entail the services of attorneys and possibly even accountants and so forth. And I think that's really more along the lines of what you want to talk about today, is for those perhaps more affluent clients that are probably at risk of running afoul of some of the tax changes that we're expecting to see in the next couple of years. So why don't you tell us a little bit of, how should we be incorporating, and how does insurance play a role for those kinds of clients?
Absolutely. That sounds great. And what I'll do is I'm going to just share my screen here, and we will hop in to a little presentation as we get going. Can you see my screen all right here?
I can.
All right, perfect. Quick little disclaimer. Again, this is meant for educational, not for use with the general public. And myself and E4, we do not give legal or tax advice. So to your point, John, again, when we start talking to clients about their estate plan, most people in this industry, most financial advisors are not also attorneys. So it is important that we have an estate planning attorney that the clients can work with. So again, as you get further and further along in your career in this great industry, the more partners you can create and establish, attorneys in particular, it can certainly help you enhance your practice. So as we go through today, really we're going to look at 4 different things. How do you initiate an estate planning conversation? Because again, as a financial advisor or an insurance advisor or an insurance agent, whatever your title might be, how do you initiate that conversation, and really why would you want to do that? What does an ideal client profile look like? I know that's something that we talk about with our advisors and are starting to do more and more of that. How can we kind of identify who to proactively approach on these topics? How can insurance enhance someone's estate plan? So again, to the meat of the conversation there, and then really just looking at 2 opportunities to put into practice as our advisors that we work with. So we'll start with starting the conversation, because again, financial advisors, we don't put together the wills, the trust, those types of things. But again, we can start that conversation because you, as that customers, that individual, that family's trusted advisor, you've got their ear. So first and foremost, and this is something I've heard, anybody who's heard Dan Peterson talk has heard him say this once, twice, or a couple hundred times. People don't like what insurance is, but they love what insurance does. And really what that means, and we're going to kind of go in backwards order here as far as starting the conversation. So the last thing to think about as you're talking to these clients, people don't like what insurance is, but they love what it does. So really what I mean by that is, as we're talking with these clients, it's important that we focus on the client's goals. If we start leading with product, we have to then find a problem for it to solve. And that's a recipe for disaster. You're going to be looked at as a salesperson. So again, we want to focus on those clients' goals, and insurance, as we'll get into today, can add a lot of value to somebody's estate plan. And so in order to focus on a client's goals, as an advisor, we need to know what questions to ask. And again, everybody's going to have their own different style, their own fact finders, but ultimately, in my years of being in this business, there's really a handful of things that you really need to get to know about these clients that you're working with. What's the family makeup? Obviously, we're going to learn about the assets that they have. But ultimately, that family makeup, who's going to get the assets? If there's business interest, if there is farmland or anything along those lines. What's the income needs? Again, those assets, once you get to retirement, you're no longer stashing money away. You're then generating those income from those assets. And then lastly, goals and concerns. What's important to them is kids, grandkids, church, charities, understanding who and what is important to these clients. So then as you start working with your client's legal team and tax team, you can really use that as a bedrock or a cornerstone to start developing those conversations. Because again, insurance isn't somebody's plan, but it can help fund the plan if I want to leave money to kids, if I want to avoid estate taxes. And again, we'll get into that in just a little bit. Third, and really the second thing that I think is important, is you've got to have good relationships with estate planning attorneys. And when I say that, you don't have to. You can certainly always go and partner and work with your client's attorneys. But what I found over the years of doing this, not every individual, not every family has an estate planning attorney that they work with. And some of the most wealthy ones, I can think of probably the 2 or 3 largest net worth clients that I've worked with. Only one of them actually had an attorney. The other 1 or 2 had nothing. So it started with a introduction to an attorney that A, was going to fit their needs, and B, be a good match personality wise. So again, you can enhance your business by enhancing those estate planning attorneys you work with. Joining estate planning councils is a great way to rub elbows. And then ultimately, it really helps to study and know some of the basics when it comes to estate planning. Because again, even though I don't practice estate planning, I'm not an estate planning attorney, I know quite a bit of the basics and some of the more advanced pieces that I can at least have those conversations to tee up with those attorneys. And first and foremost, kind of again, like I mentioned, going in reverse order, it starts with proactively mining your existing clients. We had Shane Van Patten on a couple weeks ago talking about long-term care planning, and he does a great job of, kind of segmenting those clients. Same thing is true if you want to have an estate planning conversation. Who is that ideal client profile? Again, we'll get into that here in just a couple of slides. And if you don't have that conversation with your client, who is? The old adage is, if I don't have that conversation with my client, somebody else is, and I'm going to lose that business. But more and more in reality, if we're not having that client conversation, maybe nobody is. These clients become friends, they become family. You want to make sure that they're well taken care of. So now we'll move into that ideal client profile. And again, John, to your first question, who needs an estate plan? Everybody. Everybody needs an estate plan. So again, this is that ideal client profile, but let's say you've got somebody that's 25, they're just getting started, maybe they got a house, had their first kid, maybe they're 30, 35, whatever it is. They don't have $5 million in net worth, but they've got some assets they're accumulating, they've got a family, they've got kids. Probably not a whole lot that you're going to do from a planning perspective that's going to move the needle with large insurance planning. But again, having those relationships with the attorneys, you can get them started to, again, start discussing, hey, let's get a will, let's get a power of attorney, let's get a healthcare directive. But now if we want to really start proactively searching through our clients, who do you know? And 3 big things that I'm going to talk about here. Who has a net worth of $5 million or more? So who in your book, who do you know that's got $5 million or more of net worth? Who's a business owner? And anybody that's a farmer or rancher. So again, if you look at that $5 million number, so if you've got somebody with a net worth of $5 million or more, most likely that estate is going to continue to grow. And again, right now, the federal estate tax limits are certainly high. We talked about that on an earlier brew this year. But in 2026, they're set to sunset and go back much lower. Minnesota, which is a state we have a lot of advisors and clients in, they have their own state estate tax, which again starts at $3 million. So again, when you've got that $5 million of net worth or more, you're looking at estate taxes. You're also looking at more affluent clients that can afford to transfer some of their assets in the form of premium dollars to different insurance products. So again, it's a good value, good use of time for our financial advisors. Secondly, business owners. Because again, eventually, everything that's on the business balance sheet flows over to the personal balance sheet. And again, what that means is, ideally, you grow a business, you sell it, and so again, once you sell it, those business assets go from your business P&L to your personal bank account, investment account, whatever that might be. So now those are personal assets. But even if you don't, even if you hold on to that till death, that is still going to be counted. Those business assets are going to be counted in your overall personal balance sheet or gross estate. And lastly, farmers or ranchers, really talking to them about who's the successor of the farm, wanting to keep it in the family. And then lastly, if a large amount of that net worth that they have is tied up in farmland, that's a very illiquid asset. So how are any estate taxes due going to be paid? Are they going to have to sell off the farmland for pennies on the dollar? So we want to be able to avoid that. So those are 3 real ideal client profiles that you can look at and work with your regional vice president and contact here at E4 to say, hey, how can I potentially help these people? So the other big thing, how can insurance enhance an estate plan? So really, once you start having those conversations, again, we're not leading with product. We're not leading with life insurance or long-term care coverage. We're leading with something. How do we create a plan for your clients that's going to ultimately meet their goals? And adding insurance to a plan oftentimes makes sense, because if you look at on the screen here, what does insurance provide? Insurance provides liquidity, leverage, tax efficiency, and predictability. And when it comes to estate planning, those are very important things to look at. Because again, liquidity, what does that mean? That's one of our core things that we do here at E4 is we help create liquidity. When somebody passes at the passing of the second spouse, if there's going to be estate taxes due, it's due within 9 months. Life insurance creates a liquidity event that you get that money very quick. So if you need that, or if you're, again, passing money on to kids, grandkids, charities, it's there timely and efficiently. Leverage. As soon as I make that first premium payment, whatever it is, $1, $1,000, $100,000, $1 million, whatever that premium payment is, as soon as I make that first premium payment and my policy goes in force, I get instant leverage up to that higher death benefit or long-term care coverage, whatever that insurance is that we're looking at. So again, when you're looking at those and talking to the affluent clients within your books of business, being able to leverage low-yielding assets, cash type of assets, for larger tax-efficient assets, oftentimes makes a lot of sense in a client's estate plan. We look at tax efficiency. So again, for life insurance, it's income tax-free in most cases, as long as you're not taking a tax deduction for the premium. And it can be estate tax-free as well. We'll get into that into one of our opportunities that we'll cover here in just a minute, with using certain types of trust. So again, great tax efficiency and predictability. We know the value at the end from the beginning. So again, if I know I want to leave a certain amount to kids, grandkids, charity, whatever it is, I have that predictable amount. So again, in an estate plan, here's those 4 things insurance provides, and any of the financial and insurance advisors we work with can hang their head proudly to know that insurance can help their client's estate plan, because it provides liquidity, leverage, tax efficiency, and predictability. So to finish up here, just a couple of opportunities to look for. And we're going to spend just a couple of minutes here going through these. Leaving a $1 million legacy. What does that cost? Again, putting unwanted RMDs to work. What does that really look like? How do I leave a $1 million legacy if I want to leave it to kids or grandkids? And I've got excess retirement dollars. I don't need my RMDs. I don't need those required minimum distributions. Well, let's take a taxable asset, turn it into tax-free dollars with life insurance. The ideal client, again, they've got those excess retirement dollars available and they want to pass on to heirs. And then lastly, creating tax-free wealth outside of the taxable estate. So again, we'll look at that. How can you freeze, squeeze, or burn your estate? You want to grow wealth predictably in a leveraged manner outside of the estate. And the ideal client here has a net worth of $5 million or more. So I'm going to share just a different screen here real quick, and then we'll go through these. So
Steve, before you jump into that, and I want to, you threw up 3 words there. It sounded a little bit like a catchphrase that maybe you could explain a little bit more. Freeze, squeeze, or burn. What do you mean by that?
So that really, it's just a different estate planning tactics, because as we look at clients, look at individuals and families, and they've got an estate, whether it's $1 million, $5 million, $100 million. If they own those assets personally, their gross estate is going to continue to rise, which is going to increase the amount of estate taxes due at their passing. Most clients that we work with, when you ask them, hey, I'll use myself as an example. I want my beneficiaries, when me and my wife are gone, to be my 2 sons, Kellen and Briggs. So again, you draw that out. Hey, your net worth is X, whatever it is. Kellen is your beneficiary. Briggs is your beneficiary. And then you got those affluent clients. Well, what about the third beneficiary over here, the IRS, the state of Minnesota, wherever you live? They're going to get up to 40% over the exemption amount if you don't do anything. So let's have a conversation with your attorney, Mr. and Mrs. Client. How can we freeze your estate, basically stop the growth? Let's grow all your wealth outside of your taxable estate. How do we squeeze it? Maybe that's a tactic where we start making that gross estate smaller and building wealth outside of the taxable estate. Or how do we burn it? Again, how do we start just burning it, giving it, let's be charitable during life and afterwards. So just kind of a fancy way that to talk to those clients, like you said, almost a catchphrase. Hey, let's get with your attorney, figure out how do we start growing these dollars outside of your state instead of inside of it.
Okay. So I want to leave $1 million.
Yep.
How much does that cost me to do that?
That is a great question, John. It's like you know exactly where I'm going. So before I get to the $1 million legacy piece, I'm going to take 10 seconds and show everybody that's watching this screen here. At E4, we've invested in technology, and we have what's called, when you log into your website, we've got what's called Marketing Central. Click here. It's going to open up a new window, and all of the great pieces our marketing team puts together, it's right in here. If they get updated, this is the most recent copy of everything that's out there. So all the great marketing pieces that you see put together, this is where it comes from. So I went ahead and I opened up and I got that. Are you now seeing the $1 million legacy piece, John?
I am.
Perfect. So I saved this from Marketing Central earlier today to make sure I had the most recent numbers. So we can do this with guaranteed universal life. We can do this with protection indexed universal life or variable universal life. I just so happen to pull the protection index universal life. And again, it talks about how much is it going to cost me. This isn't any carrier specific, just gives kind of good round numbers. How do I leave $1 million in this case with a protection index universal life? So let's say we've got a husband and wife and we want to get the leverage of a second to die policy. Say they're 65 years old, preferred non-smoker. We'll actually look at standard non-smoker. So not the preferred, just the standard non-smoker. The annual premiums for two standard non-smoker 65-year-old is going to be right around $16,000. So in this case, $15,967. So over the next 20 years, when I get to age 85, if I take that times 20 years, I've put in a little over $319,000. If we pass away at age 85, that's almost a 10% internal rate of return on my money. So again, tax equivalently, because it's income tax free, I've got to get almost 16% on my money tax from a not as tax efficient asset. Excuse me, I'm blanking on my words there. But again, with the tax efficiency, you're getting almost 10% income tax free in a predictable manner. Again, 60-year-old, you can see that a little under 12,000. What I put in about 8.5. 75-year-old, yeah, it cost me 33,000 and change a year. But over 10 years, I put in about 332. That's over 19% tax free at age 85, which is right around life expectancy. So again, this shows the power of not only the predictability, the tax efficiency, but that leverage you get with insurance. And by the way, John, if you own that $1 million inside of an irrevocable life insurance trust, which I've done a brew on in the past, that not only is income tax free, but it's also estate tax free. So great marketing piece you can look and have available for your clients. Now the second one, we talked about that freeze, squeeze, and burning, and I'm going to try and go through this here in just a couple of minutes to be respectful of time. This is another piece that John and our marketing team here has put together for all of our advisors as some thought pieces. So again, when it comes to legacies, there's two choices. Which would your client prefer? This, again, just simplistically, you've got a big green box right here. That's their estate now. When you die, the box all of a sudden got smaller. That's what the beneficiaries are going to inherit. And this red area, that's what's going to the government in the form of estate taxes. Or would the clients like to, let's repurpose that little corner here. So we're passing on a box that's just as big, if not bigger, without the money going to the government. Doesn't it make sense to get that leverage, predictability, and tax efficiencies? And on the second page here, it really goes through that story. So again, you've got a client worth $10 million in 30 years. We're going to assume that estate, they didn't do the planning, John, and go the free, squeeze, or burn type of mentality. They said, hey, let's grow it. Let's own it all, and we get to 45 million. Whoop-de-doo, I've got a lot of money. Now at that second passing, they're going to owe at the second death. So again, if the tax laws don't sunset, they're still going to owe $7.5 million. So they're going to pass on 37.5. Now, if the current tax laws do sunset, that $7.5 million state tax bill goes to 12.5. They're passing on 32.5. Whereas I've got that $10 million estate. I repurposed that little bottom right corner, if you remember, about 3.6 million. In this example, it's funding a SPIA, or a single premium immediate annuity, owned by the Irrevocable Life Insurance Trust, that also owns a $25 million second to die life insurance policy. So that SPIA is going to pay the life insurance premiums for the remaining of both lives. So I've shrunk my estate. I've squeezed it down to 6.4 million, but I've also grown it outside of it. So now in 30 years, my 6.4 million is 27.6 million. So again, I don't quite have as much as that 45 in the above. I owe 2.6 million at the second death. But again, that's all taken care of with that. I've still got 25 million left over, plus that $25 million income and estate tax-free death benefit known as life insurance. So with that same 10 million, I'm now passing on 50 million as opposed to 32.5. And again, it seems very simple, very easy, and that's the real reason for those marketing thought pieces that John and the marketing team here creates. It's to get you thinking. It really isn't overly complex, but it starts with, oftentimes it's a 6, 12, 18 months, maybe 2 years before you get the clients to take action. But it starts with identifying the clients and then figuring out their goals. How can we help enhance their estate plan with insurance? So we got a little longer than I probably should have, but estate planning is a topic I'm really passionate about, and hope everybody found value.
Yeah, I think, and by the way, I think a lot of these topics, when you really start, getting into the bits and pieces of them, can tend to run longer than, probably 10 minutes to have an intelligent conversation about it. Let me ask one question before we wrap up today. What is the urgency of having this conversation now, as opposed to 5 years from now?
Well, the biggest urgency is twofold. Obviously, if you want to integrate insurance into somebody's plan, the longer you wait, the bigger chance. Not only are you getting older, but that's minute compared to what happens if I become uninsurable and I can't act on these. But really, if you look out into the world, come January 1st, 2026, the current estate tax laws that were passed in 2017 Tax Cut and Jobs Act by President Trump, those are set to sunset. So right now, our federal estate tax exemption this year is 12.92 million. That's set to sunset in 2026. So the attorneys I talk with, they all think it'll be somewhere between 6.5 and 7 million, because they'll go back to pre-Tax Cut and Jobs Act adjusted for inflation. So somewhere in that 6 to 7 million. So it's a big hit. Those highly affluent clients can look at gifting to certain irrevocable trusts and lock in that high exemption. So if they've got 13 million, 12.92, times 2 for each spouse, they can gift it and start to freeze, squeeze, or burn their estate and grow it outside in an efficient manner. And if they like, insurance can offer that tax efficiency, predictability, and leverage that we hear very often around here.
Steve, thank you so much for the share today. And I would encourage anybody that's listening to this that has an opportunity to talk with their clients about estate planning to reach out to either Steve here at E4 Insurance Services or to their respective RVP, Regional Vice President, who can help provide both the marketing materials as well as help navigate and design some of those solutions for your clients. So Steve, thank you once again for being on the show. And we look forward to having you the next time you're around. For those who are watching today or this week, we will not be doing a brew next week because of Thanksgiving holiday, but we'll be back again the week after that. Thanks again, Steve.
You bet. Thanks, John. Appreciate it.
And we'll see all of you next time on the brew.